What if the biggest risk in your financial life is not market crashes, recessions, or even Bitcoin's volatility? What if the real danger is doing exactly what you were told was responsible? Saving diligently, avoiding debt, and relying entirely on income. What if the rules that worked for your parents are mathematically guaranteed to fail in a system built on inflation, leverage, and expanding debt? And what if Bitcoin is not just an investment, but a tool that exposes why those rules no longer work? According to Mark Moss, most people are trapped inside a financial system that quietly punishes savers while rewarding those who understand leverage, taxes, and incentives. He argues that Bitcoin is not about getting rich quickly, but about escaping a game where income always loses to inflation over time. And once you truly understand how this system works, Mark says you stop asking how much Bitcoin you own and start asking a far more uncomfortable question. How do you build a treasury that can survive no matter what happens next? Hello everyone, and welcome back to another podcast summary video. In this one, we break down Mark Moss's recent appearance on the What Bitcoin Did podcast. While the conversation begins with Bitcoin, it quickly expands into something much broad. What starts as a discussion about money turns into a deep exploration of debt, leverage, taxes, liquidity, and why the traditional model of working, saving, and retiring is quietly breaking down. This episode runs well over an hour, but we've distilled the most important ideas into a clear, structured breakdown, so you can focus on what actually matters without having to listen to the entire conversation. If you find these summaries useful, please like the video, subscribe to the channel, and share your thoughts in the comments. It genuinely helps support the channel and keeps this content coming. Now sit back, relax, and be prepared to rethink how money, risk, and Bitcoin actually fit together. Mark begins by challenging one of the most deeply ingrained beliefs in personal finance, the idea that all debt is bad. According to Mark, debt itself is not the problem. The real danger comes from using debt without understanding the system you are operating within. In today's economy, access to credit is everywhere. 0% April credit cards lasting 12 to 18 months, personal and business lines of credit, home equity loans, and increasingly, loans backed directly by Bitcoin. Many people unknowingly have access to well over $100,000 in available credit, yet they are taught to fear it, ignore it, or use it incorrectly. Borrowing at high interest rates to buy depreciating consumer goods creates permanent financial drag. It locks people into a cycle where payments grow faster than progress. Borrowing at low or fixed rates to acquire assets that generate cash flow, depreciation, or long-term upside is an entirely different activity. It is how corporations, institutions, and governments operate every single day. The system is not allergic to debt. In fact, it is built on it. The difference is who understands how to use it and who does not. At the center of Mark's framework is a simple but radical goal. He does not want to work more hours. He wants to build a treasury. He illustrates this with a practical example. Someone earning $100,000 per year, already working 50 hours a week. That person has no more time to sell and no more energy to squeeze out. At that point, effort is no longer the constraint. Structure becomes the constraint. Instead of chasing promotions, side hustles, or longer hours, the focus shifts to capital allocation. How do you keep more of what you already earn? And how do you convert that retained capital into assets instead of liabilities? Earned income is heavily taxed in most jurisdictions, but certain assets are treated very differently. Real estate, Bitcoin mining equipment, technology, infrastructure, and research and development all allow depreciation. Depreciation reduces taxable income, which frees up cash flow. That freed capital can then be redirected into Bitcoin without increasing workload or relying on additional labor. The outcome changes, not because you worked harder, but because the structure changed. This is where the numbers start to become uncomfortable. Without any strategy, someone earning $100,000 per year might pay roughly $60,000 in combined taxes over time. With depreciation strategies in place, that tax burden can fall closer to $40,000. That difference, $20,000 per year, is no longer being extracted by the government. Over 5 years, that becomes $100,000 redirected into Bitcoin. In some of the scenarios Mark outlines, especially when multiple assets are layered together, the total capital flow can reach $500,000. And all of this happens before Bitcoin appreciation is even considered. The income stays the same. The hours stay the same. Only the structure changes. The rules that make this possible are not hidden or illegal. They already exist. Most people are simply never taught that they exist, let alone how to use them. Once assets are established, Mark says an entirely different dynamic begins to take shape, one that most people never experience because they never make it past the income stage. Instead of relying on wages to fund daily life, assets themselves become the engine. You borrow against those assets to cover living expenses, while redirecting earned income back into acquiring more assets. The reason this works is subtle but critical. Borrowed money is not taxable income. That single distinction changes everything. Assets provide collateral. Collateral enables borrowing. Borrowing funds lifestyle expenses. Meanwhile, income is no longer consumed. It is preserved and redeployed to grow the treasury. Over time, the treasury compounds, not because of luck, but because the structure itself reinforces growth. But Mark is very careful to emphasize one thing. This flywheel is not forgiving. When managed with discipline, conservative loan-to-value ratios, and deep respect for risk, it can dramatically accelerate wealth creation. When approached casually or emotionally, it does the opposite. It magnifies mistakes. It punishes ignorance. And it is completely indifferent to good intentions. According to Mark, the greatest risk most people fixate on, Bitcoin's volatility, is not actually the thing that destroys them. The real danger is liquidation. Volatility only becomes fatal when it collides with poorly managed leverage. To explain this, Mark uses a simple but powerful analogy. Leverage is like surfing. The ocean itself is not the threat. Waves come and go, sometimes calmly, sometimes violently. What determines survival is preparation, positioning, and skill. A beginner paddling out during a storm does not get unlucky, they get overwhelmed. The same logic applies to borrowing. Borrowing at 80% loan to value near market highs means a 50% Bitcoin drawdown can wipe you out completely. At 30% loan to value, that same drawdown becomes painful but survivable. At 10%, liquidation becomes extremely unlikely, even during severe market stress. Mark stresses that risk tolerance is not emotional. It is structural. It depends on where you are in the market cycle, how stable your income is, how much liquidity you have available, and how quickly you can access capital if conditions change. This is not speculation. It is risk management, and ignoring it is how people learn the hard way. Mark operates with a strict set of treasury rules designed to remove emotion from decision-making and prevent small mistakes from becoming catastrophic ones. The first rule is never borrowing above a predefined loan to value, no matter how confident the outlook may feel at the time. He also refuses to accept negative carry, situations where the interest cost on borrowed capital exceeds the expected growth or cash flow of the asset itself. If the math does not work on day one, it will not magically improve under stress. Another core rule is never using cash to buy depreciating consumer goods. Cash, in Mark's framework, is a strategic resource meant to protect liquidity and expand the treasury, not to fund liabilities that steadily lose value. Finally, he always prepares for drawdowns before they occur, not after. This means planning for volatility as a certainty rather than a possibility. These rules are not designed to maximize short-term gains. They exist to keep you solvent, disciplined, and in the game long enough for compounding to quietly do the real work. One of the most advanced strategies discussed involves borrowing directly against Bitcoin, but Mark is careful to flip the narrative most people are familiar with. The common assumption is that Bitcoin-backed loans exist primarily to buy more Bitcoin. According to Mark, that mindset skips several critical steps and introduces unnecessary risk. The real priority comes first from eliminating taxes. Borrowing against Bitcoin becomes a tool, not for speculation, but for restructuring cash flows. The borrowed capital is used to acquire Bitcoin miners, which then introduce depreciation benefits that can significantly offset taxable income. Those miners begin producing Bitcoin, creating a new stream of assets without selling existing holdings. Over time, that newly mined Bitcoin itself becomes additional collateral, allowing borrowing capacity to expand further. This is where the flywheel begins to accelerate, not through price prediction, but through compounding structure. But Mark is explicit about the danger here. This is not beginner territory. These strategies only make sense after education, liquidity buffers, and strict discipline are already firmly in place. Without those foundations, the same tools that build a treasury can just as easily destroy one. Mark openly agrees with conservative financial advice when it comes to the majority of people. For roughly 90% of individuals, Avoiding leverage entirely is not just reasonable, it is the correct decision. Leverage is not a prerequisite for success, and for most, simply staying unlevered is the safest way to build long-term resilience. He returns to the surfing analogy to make the point clear. Not everyone belongs in the water, and certainly not during rough conditions. Leverage amplifies both outcomes and mistakes, which means it demands a level of preparation that most people neither want nor need. This approach requires learning, emotional control, and genuine respect for risk, not confidence or bravado. Starting small is not optional, and skipping steps is how people get wiped out. According to Mark, leverage only works for those who are willing to treat it as a responsibility, not a shortcut. Before taking on any meaningful risk, Mark breaks liquidity down into clearly defined layers, treating it as the foundation of the entire system rather than an afterthought. The first layer is operating capital, enough to comfortably cover 3 to 6 months of living expenses without relying on markets or borrowing. This is what allows decisions to be made calmly instead of under pressure. The next layer consists of cash equivalents that can be accessed within days, not weeks. This includes highly liquid reserves that act as shock absorbers during sudden volatility or unexpected expenses. Beyond that are collateral assets, such as Bitcoin-backed loans and established credit lines, which provide flexibility without forcing asset sales at the wrong time. These tools exist to manage timing, not to increase exposure recklessly. At the base of the stack sit illiquid assets, including private equity, land, and long-term deals that may offer strong returns but cannot be quickly accessed. The deeper and more balanced this liquidity stack becomes, the more resilient the overall system is. According to Mark, liquidity is what allows you to survive volatility and use it strategically, rather than living in constant fear of it. Mark once owned more than 200 rental units, building a sizable real estate portfolio over many years. But in 2021, he made a decisive shift, selling a large portion of those holdings to allocate heavily into Bitcoin. That move was not a rejection of real estate, but a recognition of how the monetary landscape was changing. Real estate still plays a role in his framework, particularly through depreciation benefits and select lifestyle assets that offer personal utility alongside financial value. However, as an investment vehicle, Bitcoin offers a superior risk-adjusted return with far less friction. There are no tenants to manage, no maintenance calls, no local regulations, and no counterparty risk tied to leverage-heavy property markets. Mark argues that everyday investment real estate is slowly being demonetized, as rising costs, tighter margins, and increased regulation erode its effectiveness as a store of value. Scarce and truly desirable properties will continue to retain value, but the broader monetary premium is increasingly being absorbed by Bitcoin across the global system. Mark often refers to Bitcoin as the cheat code, not because it promises easy gains, but because it changes the rules of the game entirely. Simply holding Bitcoin over time has already outperformed hedge funds, private equity, and venture capital, even after accounting for volatility. But according to Mark, the real advantage comes from building systems around Bitcoin rather than treating it as a passive trade. These systems are not based on speculation or short-term price movements. They are built on alignment with a monetary network that cannot be diluted, manipulated, or debased. In that environment, time, discipline, and sound structure are rewarded, while impatience and excess are punished. This is where hustle culture begins to break. Not by working longer hours or chasing higher income, but by choosing better money and letting compounding do the heavy lifting over time. Retirement, Mark argues, is largely a product of the fiat era, built around the assumption that money steadily loses value and people must eventually exit the workforce to survive. In that framework, the goal becomes escaping work as early as possible. Mark flips that idea entirely. The real objective is not to stop working, but to stop being forced to work. When your time is no longer sold out of necessity, work becomes a choice rather than an obligation. Bitcoin supports this shift by allowing people to remain creators instead of defaulting into consumption. It gives individuals the ability to choose what they work on, how they contribute, and when they decide to do it, without being trapped by a system that constantly erodes their purchasing power. According to Mark, Bitcoin is no longer driven primarily by halving cycles or isolated supply shocks. Instead, it has become increasingly tied to global liquidity conditions. Falling interest rates, expanding balance sheets, and political pressure to stimulate growth all play a central role in shaping the broader market environment Bitcoin operates within. He expects liquidity to continue increasing into 2026, even if the path there includes periods of short-term uncertainty and volatility. Governments remain structurally incentivized to ease financial conditions, not tighten them, especially in the face of slowing growth and rising debt burdens. Political risk does not disappear in this environment, but the long-term trend remains clear. As liquidity expands, hard assets tend to outperform, while wages and traditional savings struggle to keep pace. In Mark's view, Bitcoin increasingly sits at the center of that shift. The message of this conversation is ultimately very clear. You cannot outrun inflation with income alone, and you cannot save your way to freedom in a system that is structurally designed to dilute purchasing power over time. No matter how hard you work, income eventually hits a ceiling, while the cost of living continues to rise. Assets, on the other hand, play a different role entirely. Income eventually fails, but well-chosen assets compound, adapt, and grow within the system as it exists. Bitcoin does not eliminate risk or promise certainty. Instead, it exposes where the real risks already are, especially for those relying solely on wages and savings. For people willing to learn how the system actually works, Bitcoin offers something increasingly rare: a way off the treadmill. A shift from constantly reacting to inflation toward building a treasury that compounds with time instead of fighting against it.